you should always root for your stocks to go down short term when you're adding the position. Once you have your position fully built, then you root for it to go up, and then you're like, okay, let's go, baby. Let's run this over the next 3, 5, 7 years. But like I told you guys, I'm not bullish on PayPal really into year end because I think there can still be tax loss harvesting there that could come, right? We don't know. We'll see, but I think there could be, right? A lot of people are hyped on Microsoft right now. I never thought I'd see Microsoft as a hype stock, but I'll just be honest with you guys. Microsoft's a FOMO hype stock right now because of what's going on with ChatGPT and everything they're launching there and what they showed off. It was either yesterday or the day before. It's actually a lot of hype in Microsoft stock. I never thought I would see it, but it's actually there. If we can talk about a place where real wages could get in a much better place in 2024 with unemployment still being under 4, then we could be in a place where the consumer confidence picks up quite significantly over Q1, Q2, Q3, and that's a scenario that could play out. If that scenario plays out, then ultimately it should be a pretty good year in the stock market. It should be a pretty good year in the economy overall, and a much healthier year than certainly this year has been, or even last year for that matter. Howdy there, folks. Hope everybody's doing tremendous as always. Before we even get into that, I just want to talk to everybody for a moment. And this talk is going to be a little more helpful to people that are maybe a little newer investors. So let's say people that are kind of getting in the market and getting started in 2023. So if you've been in the market for 100 years, this might not be the most helpful thing to you, but this is for the folks that are maybe newer investors. I just want you to make sure you understand this concept because when I was first getting to start the stock market, I didn't understand the concept till I was probably in my second year. Also didn't, I think most people in general don't understand this concept, okay? And this was explained to me by Warren Buffett, actually. When you're adding a position, there's a beautiful bird down there. When you're adding a position, you should root for the stock to go down in the short term when you're adding that position. Once it's fully built and you're not buying any more shares, then you root for it to go up. But in the short term, you should root for that stock to go down. It's very important. And the reason being is if you're adding a position, you'd much rather have it, you be in a position where you can add it for cheaper and cheaper. Let's say you're going to buy a stock over the next 6 months, 12 months, 24 months, like however long it is, right? You'd rather get as many shares as you can for as cheap as possible. And that means if you're right about that stock, your gains are going to be the maximum amount possible, right? And you won't get scared away from buying it as it goes up, right? Because something a lot of us struggle with is as a stock price goes up, we want to stop buying it even if we love the company because we're like, oh, now it's up 15% from where we started buying. I don't know, I want it to go back down, or, oh, it's up 30% now. I don't think I can buy it anymore, right? And even if we think that stock has hundreds of percent upside or it's a 10x opportunity or whatever, a lot of times it's hard for us to pay up for a stock, right? And so you should always root for your stocks to go down short term when you're adding the position. Once you have your position fully built, then you root for it to go up, and then you're like, okay, let's go, baby. Let's run this over the next 3, 5, 7 years. But when you're adding that position, always root for it to go down. Buffett will say that. He's the one that explained that a long time ago. I watched an old interview with Buffett. And he's like, I don't like it when my stocks start going up, when I just started buying them. He's like, I want to be able to add to a position over a longer period of time. He doesn't just go all in one day, right? That's not an intelligent decision. And so I just want everybody to kind of understand that. If you're a newer investor, I think experienced folks, you guys all get that point. But, I think sometimes newer investors in the market might not understand how that whole little game works there. All right, guys. So where I want to start here is actually TLT is starting to roll. So ever since rates pretty much bottomed out kind of toward end of October, it's been a pretty incredible run for TLT. I'm not investing in TLT. I don't really have any interest. I think there's just a lot more, let's call it interesting opportunities out there, but there's a lot of folks that are trying to time out. Rates have peaked, believing rates are going to go down. And if rates go down, bullish TLT. So there's that playing out right now, right? If you look at the indexes here today, we got the Russell down about 1.2%. So same story of 2023, small struggling, bigs rolling. Well, I shouldn't say rolling. They're not really rolling today, but they're about break even, right? That's huge outperformance, huge alpha there from the NASDAQ versus the Russell, which has been the same damn story this entire year. S&P 500's around break even here today. Dollar not doing too much. Dollar's another thing that a lot of people believe peaked already at this point in time, right around here in October. That's a belief. We'll see. I don't want to get too confident about any of these things in terms of rates peaked, dollar peaked. We'll see. But there's a belief that the dollar has peaked. There's a belief that rates have peaked. We'll see. A lot of smalls are struggling today. Struggling, thuggling. Fubo struggling. Corsair struggling. Foot Locker struggling. A lot of the smalls. Elf's more of a mid cap now, but that one down 2% here today. And we got a lot of mixed bags, a lot of 1% type movers here today. I don't have anything really doing very well today, other than the Planet is up like 5%. And then Shopify's up a little less than 2%. PayPal's up 1.2%. SDAO's a little green today. It's not a big downward day for SDAO, so not a lot happening there. So AI stocks here today, we have Palantir down about, we can call it about 2% here today. Oracle is the winner chicken dinner here today. That one's up about 3%. Nvidia looks green. Trade Desk looks green. Trade Desk reports tomorrow after the bell, so that one's going to be interesting. Hood's getting nailed today, 14%. You know, I'm impressed at least with PayPal's price action of day. I mean, the fact that PayPal's up 1% today, and Square's having a good day. Square's up 3% here today. The fact that PayPal and Square are up today, despite Upstart being down 26%, the Hood being down 14% is definitely, I think, a promising sign as far as that goes, right? But like I told you guys, I'm not bullish on PayPal really into year end because I think there can still be tax loss harvesting there that could come, right? We don't know. We'll see, but I think there could be, right? And when a stock's had a struggle year like it has, you can definitely see that into the last few weeks of the year, which, by the way, there's 7 weeks left in the year, right? Enphase down under $77 a share right now. There's still a real potential Enphase could go to 50s. Do keep that in mind. We'll see. The most green stock of my housing stocks watch list here today is Rocket. Rocket's a 3% mover. Outside of that, not too much exciting. So Enphase worst stock, and then Rocket best stock. We already looked at my stocks. Oil and gas, Red Dead Redemption. A lot of these stocks are starting to get hit heavily now because the price of crude's coming down, right? And so you look at the falls in a lot of these stocks, it's, pretty down in a straight line here recently for a lot of these guys. Microsoft's GitHub introduces Copilot assistants that can learn about companies' private code. Wow. A lot of people are hyped on Microsoft right now. I never thought I'd see Microsoft as a hype stock. But I'll just be honest with you guys, Microsoft's a FOMO hype stock right now because of what's going on with ChatGPT and everything they're launching there and what they showed off. It was either yesterday or the day before. It's actually a lot of hype in Microsoft stock. I never thought I would see it, but it's actually there. Oh, here we go.
Words in your outlook.
I want to see what this guy has to say.
A much broader group of
On closing bell.
Great to be with you, Scott.
I read your outlook here, and you sound pretty, dare I say, optimistic?
I'm pretty optimistic, and in part because we have seen such strong signs that we can bring down inflation to an acceptable level without really hurting the economy. I mean, 2023 has been sort of a proof of concept of that. We've seen very substantial disinflation across not just the US and the developed economies, but a much broader group of countries that saw an unwanted and large acceleration in inflation to an average of about 6% in 2022. It's back to 3%. There's still some work to do, but we're on a very good path.
You use interesting words in your outlook. You see tailwinds to global growth. So whereas, others would be a little more worried about where the economy is going to be in 24, you use words like tailwinds. What are the tailwinds that you see?
The most important tailwind is strength in real disposable household income growth. And that is really driven by inflation coming down very substantially, wage growth also coming down, but coming down more slowly. So real wages are now growing, employment is still growing, and that is helping consumers. I would say that's number one. The other one that I think is important, the other question, whether monetary policy is going to have a large lag negative impact on growth. We think the biggest negative impact is already behind us.
Interesting. So the labor market never falls apart. It slows, which, last month obviously was a positive read. It was one of the things that the bulls needed to see. So we continue on this steady but not stumbling path.
That's right. The labor market held up well in 2023. You take the average unemployment rate globally, it's been going sideways at a very low level. And I would expect more of the same in 2024.
Okay, what I see here too in terms of returns, I'm quoting now from your outlook. We expect returns in rates, credit, equities, and commodities to exceed cash in 2024, and that's your baseline forecast. Explain.
That's right. In some cases, only by a little bit. For rates at the long end and the short end, we don't expect big differences, but we do expect a pickup in returns in credit. We expect a somewhat bigger pickup in equities, and then we're looking for commodity prices to recover and to actually produce pretty strong returns in 2024.
It also sounds, I suppose, if you have this belief that the Fed returns to being our friend, so to speak, rather than our foe. Not only are they done hiking, but if necessary, they'll cut, and if necessary, they'll cut more than we might otherwise think.
Yeah, our baseline expectation is the Fed does nothing for the next year. But
nothing. So you don't have any cuts?
We don't have any cuts in our baseline forecast because we have a pretty constructive forecast on growth.
Well, what about? But you also are constructive on inflation coming down back towards 2%. So wouldn't they cut even if inflation comes down?
We have inflation
like
still
that.
a little above 2%. So that's consistent, I think, with a cut towards the end of next year. However, if things were to be weaker in 2024, if we saw an unanticipated, speed bump or maybe pothole in growth, they could cut in response to weaker numbers because inflation is now in a place that would allow them to cut.
We spent a good portion of this program today talking geopolitics, whether it's the David Einhorn letter that I was citing at the very top. We just, of course, had our two veterans on.
So
growth in
So this gentleman has a stance of one of my four scenarios. I have four different scenarios I think could play out in 2024 realistically, and that's one of those four scenarios. One of those four scenarios is a situation where inflation is not an issue at all in 2024, right, for companies or consumers. Consumer gets in a better spot, and we see actually a huge pickup in consumer confidence, which consumer confidence has been in the dumpers for a year and a half, basically. Almost 2 years now, but certainly a year and a half, like worst ever. Like literally last year, consumer confidence, this Michigan Consumer Confidence Survey goes all the way back to the 1950s. The 1950s, okay? We had never, ever seen consumer confidence as low as it was last year. So we've started to pick up, but we're still on such low levels. If we can talk about a place where real wages could get in a much better place in 2024 with unemployment still being under 4%, then we could be in a place where the consumer confidence picks up quite significantly over Q1, Q2, Q3, and that's a scenario that could play out. If that scenario plays out, then ultimately it should be a pretty good year in the stock market. It should be a pretty good year in the economy overall, and a much healthier year than certainly this year has been, or even last year for that matter. So it's one of four scenarios that can play out, and it's a realistic possibility. We'll see. But that's kind of what he has played out there. But this is really important, really important. With that being said, Fed cutting rates, if that scenario does play out, you're likely not getting rate cuts next year. The Fed's probably going to hold out until they see unemployment going above, I would say the Fed will probably hold out until they see unemployment going above 4.5%. That's my guess. If unemployment was to go above 4.5%, I think that would be a moment in time where let's call it, the Fed might say, okay, we're going to cut rates if it's above 4.5. So something to keep in mind there. I'm looking forward to hearing Bob Iger's interview too. That should be an interesting one to react to.
That's right, Morgan. Disney reporting a big beat in earnings and a big beat in streaming subscriber growth. The company reported earnings of 82 cents per share. That's 12 cents better than the analyst consensus. And a key reason for this beat, direct-to-consumer losses declining dramatically, plus the company announcing that it has increased what it's calling its annualized efficiency target to $7.5 billion. That's up from its previous cost-cutting target of $5.5 billion. Now getting to revenue grew 5% to $21.25 $21.4 billion. That's just a hair below the $21.32 billion that analyst consensus had been. Now, this slight miss was due to the entertainment division. Sports and parks experiences were slightly ahead or in line. Now, Disney also gave some guidance this quarter. They say they, quote, expect to grow free cash flow in fiscal 2024 significantly versus fiscal 2023, saying this will approach levels last seen pre-pandemic. Now, I want to quickly dig into the all-important streaming division. The company added 7 million core Disney Plus subscribers. That's more than double the less than 3 million subs that analysts were expecting, with average revenue per user for both core Disney Plus and Disney Plus Hotstar both beating estimates. And the direct-to-consumer operating losses decreased to $387 million from a nearly $1.5 billion loss in the year earlier quarter. Now, in its earnings release, the company did reiterate its guidance that this combined streaming businesses will reach profitability in fiscal Q4 of next year. And as the company breaks out ESPN, for the first time, ESPN operating income grew 15% from a year ago, and ESPN Plus subscribers also beat expectations. I'm joined now by Disney CEO Bob Iger. Thanks so much for joining me to talk about these results.
Thanks. Nice to see you, Julia.
It's great to be here. So I want to start off with the direct-to-consumer business. You reiterated that you're on track to hit profitability as planned, but a big beat on subscribers. You also recently just raised prices. And I'm wondering if you expect that subscriber growth to be able to continue.
Well, we do expect subscriber growth to continue, but we're mostly focused now on delivering profitability by the end of fiscal 24. We had a great quarter, as you just noted, adding 7 million core Disney Plus subs. That was really the result of great content, particularly 3 strong movies, Guardians of the Galaxy 3, Elemental, and Little Mermaid. Disney Plus is proving to be extremely popular and in demand, and we feel very bullish about its future.
So what does the future of your streaming bundle look like, especially given the fact that you're about to, or you're in the process of buying out the remainder of Hulu that Comcast, CNBC's parent company, currently owns? And how much do you expect to have to pay over that base level that you already negotiated for that remainder of Hulu?
Well, first of all, as you know, there's a floor price, which is obviously public, stated. We'll be writing them a check for that actually pretty soon. There will be an evaluation process that is dictated by the agreement that we reached with them a few years ago. I'm not going to say much more about that process, except, we expect it will be fair and ultimately objective, and we're not concerned about the price that we will end up paying. It's a great step for the company from a strategic perspective in that it gives us an opportunity to further connect the dots between Disney Plus and Hulu and ultimately offer even a 3-play or a triple bundle with ESPN. This is 3 great sets of streaming assets. And in December, we will launch in beta form
a combined
Disney Plus and Hulu app.
Big beat.
And then sometime probably in late March of calendar 24, excuse me, it'll launch basically out of beta. We feel great about it because the combination will give us an ability to essentially lower customer acquisition costs, reduce marketing,
9%
reduce churn, and most importantly, create more engagement, and that's great for advertisers. We have advertiser-supported subscriptions for both Disney Plus and Hulu. Actually, it's
not the most impressive.
You'll be able to, if you're a Disney Plus subscriber, EPS, you'll be able to upsell to Hulu for $2 more with advertising, and vice versa for Disney Plus. So this is all a great step for us.
And it seems like there's a big pressure, not a big push, not just from Disney, but from these other streamers as well, to really push subscribers to the ad-supported version of their services. How important is ad-supported going to be, and what kind of growth are you seeing in streaming advertising versus linear advertising? We've seen, and even in this quarter, linear advertising is really struggling.
Well, we can talk about both. First of all, we believe that the advertiser-supported streaming services, not just in the U.S., but in other markets, notably in EMEA, will be important growth initiatives for the company. In fact, in Disney Plus, we just implemented some really robust advertiser targeting tools that are already working and will help us obviously grow advertising. By the way, speaking of advertising, addressable advertising is very strong. And since you raised it, so is sports, by the way. I would say in linear, it's actually a little bit better than it had been. Overall, we've seen some improvement in general in advertising. It doesn't mean we don't have more improvement ahead. We actually believe we do. But for instance, technology sector has been a bit soft, but advertising looms large for us.
So we heard
and the combination of
Fubo
Hulu
said
and
that as
Disney
well.
Plus advertiser supported is a great opportunity for us to grow the advertiser supported side of our streaming business.
And just to
Virgin
make sure
lost less.
to really hit the point on the linear business, you're seeing a strengthening market there, or what's your outlook for Q4?
Linear is better than many people assumed it would be, actually. It doesn't mean it's great, but we've seen some improvement.
It's $1 now.
I want to make
It's
sure to hit on
$1?
ESPN before we return to
crazy.
linear. You mentioned sports. Given the results that were broken out this quarter, the 15% increase in operating income for ESPN, what do these numbers indicate about the type of partnership you're looking for ESPN and when that might happen?
And I noted you mentioned that ESPN was up in the quarter and thus up in the fiscal year. Is actually up in operating income and in revenue in 22 and in 23. So great trajectory. And the ratings are actually very strong too. ESPN had one of the strongest years ratings-wise, I think, in the last 4 or 5 years in 23. That's a great thing. We obviously are planning to take ESPN out on a direct-to-consumer basis. We feel great about that. We believe we have an opportunity to strengthen that hand even more by bringing in 1 or 2 strategic partners that can add either marketing support, technology support, or possibly content support. Why not go out with a stronger hand, for instance? And that's what we've been considering.
That's
We've been in discussions
interesting.
with a number of entities. I don't have anything specific to tell you right now, except I think you can expect us to elaborate more on that sometime in the near future.
So there's been an expectation that this direct-to-consumer version of the flagship product will launch by 2025. Is that right?
We've not said specifically what date. We were targeting 2025. It won't be long. It won't be later than that. And again, we're working hard to make sure that we've got the building blocks in place to see to it that when we bring it out direct to consumer, that it is very successful. And we feel great about that, but we have an opportunity to consider some strategic partnerships that I think will make the transition even more successful.
Don't get too excited.
NBA rights are
That's
the
all
next
I'll say.
sports rights that are up for grabs. How essential is it
Don't get
for
too excited
ESPN
either.
to have those rights? And how problematic is it that you have these big tech companies pushing up the prices?
Well, I'm not going to comment about the negotiation at all, except to say I've said before, NBA is very important to ESPN, has been for a long time. I should note that ESPN's important to the NBA too. We bring to not just the NBA, but to other sports organizations a level of support, engagement with audiences.
True.
Not just on linear television, but in podcasts, on radio, and online, and in apps, and I could go on and on. That's quite valuable to these sports organizations, and I don't think that should be discounted.
Well, we'll have to.
By the way, anybody in the chat own Disney stock? Let me know in the chat if any of you guys own Disney stock. I'm interested. If there's anybody, many people here that actually own the stock.
Since then,
And also, if you own Fubo stock, let me know in the chat that you own Fubo.
traditional distribution should look like, and Charter really pushed to bundle streaming rights with digital. How did that battle and the resolution of that change the way you're thinking about potentially selling these assets?
Well, first of all, I think what I said on that in that interview was that I think we were considering a number of options, or everything was on the table, or something along those lines. And I understand how that was interpreted, and it is what it is. We have been considering various strategic options for each of our networks, not necessarily all together, but each of them. We do that as a matter of course for all of our assets because we're aiming to increase shareholder value, obviously. But it's interesting because while we've been actually taking a look at the linear networks, we have uncovered a number of really interesting opportunities to reduce costs and improve the business. And in fact, you have to look at the business in terms of its strategic value to the company too. Not only its financial value, and by the way, it is profitable still for the company, but it provides a lot of strategic support for ESPN. There are a number of sports shows on ABC, for instance, for ESPN. We also bundle when we with the distributors, ESPN and those linear assets. And it's also those linear assets are very valuable for streaming, Hulu and Disney Plus. So we are looking looking in an open-minded way, but that shouldn't in any way suggest that anything is imminent. It should suggest that as part of our ongoing process, we're, one, very, very realistic about the marketplace and the future of those assets, but we also are very mindful of their value to the company today and possibly into the future. And the Charter deal, to answer your question, didn't really change our opinion about it. Look, that was a great deal for us. I think it was also a very good deal for Charter. It did enable us to reduce the number of channels that we were distributing through Charter, while also giving us some great distribution for our streaming assets, notably Disney Plus. So kind of, I'll call it a win-win for us in that regard.
Decent numbers,
and a
MGM.
real balance between traditional linear media and new media or streaming for us. But I don't think it really changed our outlook about the business.
But does that mean that, given that you're selling effectively a smaller bundle of channels to Charter, that ultimately you'll have to shut down some of those channels? And do you think other distribution deals will follow in the same path as Charter's?
Well, first of all, our core channels were part of the distribution deal. So when we talk about possibly shutting channels down, we have a lot of channels. I've argued for a long time, possibly too many. I think that's true actually for the industry. Over time, with the growth of cable, a number of channels were created. I'm not sure that serves the distributor or the consumer that well, but that's maybe for another time. But I like the fact that we're focused on fewer channels, and I think I obviously love the fact that we were able to bundle a very, very core future asset for the company, Disney Plus, into that deal.
You said that you're looking at all of your assets. Do you have plans to sell your India assets, India Hotstar assets? Any update there?
I don't have an update. I'd say the same thing about them that I said about our linear networks. We're looking in an open-minded way. We like being in business in India. We'd love to be able to strengthen our hand. I can't, at this point, predict where that will end up.
I want to ask you about Nelson Peltz. The stock is down 24% since Nelson Peltz declared the proxy fight over. He indicated, and he has teamed up with Ike Perlmutter, who formerly ran Marvel, that he is perhaps preparing for more activist action against Disney. Have you heard from him?
I had a call from him, but I must say I don't have specifics about what Nelson is really after.
I can't freaking believe it. Honest finally didn't report a disaster quarter. I almost want to cry. I might have to make a move on Eli next year.
Part of parks, but the international parks are doing.
This has been interesting. Top Golf, I'm trying to figure out why this stock is absolutely plummeting right now. And I mean, it is plummeting hard. I mean, I've seen it down between 18 and 20% in this after-hours trading session. This is an insane move. And I'm like, this stock has already been hit hard, right? It was a $25, $26 stock just in the past 52 weeks. So going into this is down 50% plus from its 52-week high, right? To get pummeled like this, you have to report a disaster. And so far, I'm not seeing disaster. Net revenue is up 5% for the company. Constant currency basis 4.6%. Yeah, maybe the Fed will cut in 2024. That's one of the four scenarios. The Fed does cut. We'll see. I can tell you that's not something I would look at and be very bullish on necessarily for the economy in the short term. That's not good. Okay, we got a lot going on. So Disney, okay. That's how I feel about Disney. Disney, okay. Affirm obviously reported good numbers, but you can never really trust the gains necessarily in Affirm. One is there's still going to probably be more tax loss harvesting in this year, and also two, just still a lot of people don't want to own anything buy now, pay later. So sometimes these stocks can get pops for a day or two, and then they give it all back. And that's kind of been the obviously what's happened with Affirm for a long period of time. So, damn, Affirm was $164 back at the end of 2021. That's wild. Instacart, poop stock. Lyft, poop stock. Twilio had a nice earnings beat, up about 7% there. A really nice EPS number. Revenue number, not the most exciting, but nice EPS number. AMC, I guess their earnings haven't come out yet. That one's not moving. Honest, I wouldn't be surprised if it's a big mover tomorrow. And over the next bit of time here, we finally got some momentum in Honest. Thank goodness. Thank freaking goodness. The thing with Honest is as long as it wasn't a disaster, the stock could pop big. That's bottom line with Honest, right? As long as it was not a disaster, it could pop big. And we finally got a quarter that it's like, oh, we actually moving some things in the right direction here. So thank goodness. Thank freaking goodness. That's all I have to say. Eli, I can understand why that stock's getting hit insanely hard. I just looked at their numbers, and it's just, I mean, when you have that sort of bad guide in this market's not going to give you the benefit of the doubt. And that's why the stock is down huge. Do I own Honest? I own like 60,000 shares in one of my portfolios still. Thank the Lord that finally maybe Honest is coming around a little bit. They got a lot of ground to make up, though. Let's be clear about that. But things are moving in the right direction. The thing that I was interested in, diapers and wipes were actually down in the quarter. But retail consumption increased dramatically, which means likely a big retailer just hadn't placed orders in the quarter, and those big orders are probably coming next quarter, I would guess, right? Because if consumption is that strong, but your revenue was down, because sometimes these companies will just basically place massive orders and then they won't order like the next quarter and things like that. Like we even used to do stuff like that with beer at Quick Trip back in the day. We'd have some huge order, and then the next week or next several weeks, we wouldn't need to order anything because we just make this massive order and actually get a discount from Anheuser-Busch or whoever was just distributor back then and things like that. So, but yeah, so bottom line with Honest, they didn't report a damn disaster. And for Honest, that's a freaking win. And so I'm not surprised the stock's up 13%. I wouldn't be surprised if it's up like 30% tomorrow. We'll see. But, okay. So, yeah, good to hear they got the ship in the right direction at least. When it comes to Honest, it gives us some hope for obviously 2024. So Disney finished up about 3% roughly in after hours trading here. Affirm up about 11% in after hours trading. Instacart break even after hours trading. By the way, let me check ARM. Let me see what happened to ARM after hours. There was another big one that reported. ARM looks like it's down all the way to Chinatown. About 8% ARM is down after hours. Lyft is down 1% after hours. Twilio's up 7.5% after hours. AMC is down as that stock always is. Honest is a big winner chicken dinner. Who would have ever thought Honest would be the winner? But they are the winner. And then Eli's the biggest L of pretty much all these companies that reported after hours. That went over 15% down. Could we see a Topgolf with a 9 in front of it tomorrow? It's certainly a possibility. Certainly a possibility. So, yeah, overall, and then the Planet reported, those numbers were just meh. Like not exciting at all, obviously, which is to be expected. Like 2024 is supposed to be a pretty exciting year for the Planet, though. So with obviously Illinois and Florida coming online. So, but overall, I got to say I'm happy that at least Honest is in a place where the ship's turning the right direction, and we got a lot more progress to make there. But it's at least a step in the right direction. Now tomorrow, after the bell, Unity. Trade Desk, Wynn Resort is going to be really interesting. Canopy, Aurora Cannabis as well, and a few others are going to be reporting that aren't up here. But for me, all eyes will be on Wynn Resorts tomorrow in terms of what they report after the bell. Hoping for, I don't really hope actually the numbers are good. The numbers are probably going to be good for Wynn Resorts. Much love as always, folks. Thanks for being here. Much love, folks. See you on the main channel tonight, and peace.